Hey friends, welcome back. Assalamu alaikum. So, the third tool for the financial statements analysis and very frequently used tool is the ratios, right? So, what ratios actually do, uh, they convert the absolute indicators, absolute uh, signals into relative signals, and relative signals actually help us compare one company to another company, one company to an industry, one company to the same company's previous years or previous periods. So broadly, there are different authors classify ratios in different segments. So the author of our course book has actually discussed ratios in the umbrella of three groups, and these are the liquidity ratios, profitability ratios, and solvency ratios. And we have gone through some of the ratios already in while we were discussing other deeper issues in accounting. So let's do see what the liquidity ratios are. So these are the ratios which measure the short-term ability of a firm to pay its maturing obligations and to meet unexpected needs for cash and also to meet the expected needs for cash as well in the short period. So usually by short period we mean 1 year. So what is the financial health of the company in terms of its ability to meet the expenses that it will incur in the next year? Number one, the liabilities that are becoming due and to be paid off the coming year, and maybe any unexpected needs in the short run, right? Not abnormal but normal. So some of the ratios, right? Uh, Current ratio, right? We have already discussed this ratio, which is the current assets upon current liabilities, right? So this can be shown something ratio 1. So this something, which is the current asset proportion, can be less than 1, it can be more than 1. Usually it is assumed desirable, it's assumed safe if the current ratio is more than 1. Uh, and A company can survive still with a current ratio less than 1, provided that the company is a sort of a blue chip company, that is, it's very strong brand, it holds very strong brand equity, its forecasts are very strong, so whatever sales, whatever revenues, whatever profits the company has generated this year, it is very much expected that the company will at least generate the same amount of profits and revenues next year. But usually it is assumed that this ratio should be more than 1. Some orthodox authors also say that this should be 2:1 or more than 2:1, as we say in this particular company case that it is actually more than 2:1, right? So this means that we have 2 times as much assets as our current liabilities are. So we have sufficient amount of current assets to pay off our current liabilities. The next important ratio uh, is the acid test ratio. So in the acid test ratio, what we do is actually, again, there are different approaches. We also used to say this quick ratio, QUICK, quick ratio or acid test ratio. This is another version of the current ratio, right? But rather a restricted version of the current ratio, in which we do not take all the current assets in the numerator. The current liabilities are same in the denominator, but in the numerator, we deduct those current assets which are not more liquid, right? So those current assets for which the cash is not supposed to be generated very in the very short term, very easily, we deduct them. So again, there are different approaches to work out these ratios. In some of the books, you will see that they just exclude the inventory from the current assets. They keep all the other things. But the author has also excluded the prepaid expenses. Some authors also exclude the receivables, right? So they just take the very liquid assets. So whatever formula is, the formula is usually provided, and it depends on the needs of the organizations and what is the perspective for which the ratio is being worked out. But the way this author of our book has worked out is that he excludes the prepaid expenses, excludes the inventories, and then the remaining current assets are taken in the numerator, and the current liabilities are taken in the denominator. So this will be lesser than current ratio, of course, because the current ratio will have a bigger numerator, a larger numerator. Um, and Again, this ratio, if it is 1 or more than 1, then the company is said to be safe. If it is less than 1, then there are chances that the current liabilities, if the inventory is not converted into cash, not sold, or sufficient amount of cash is not generated, the company might be in difficult circumstances. So over here, they are also comparing it with the industry average as well, right? For example. So another liquidity ratio, again, which we have already studied earlier, is the receivables turnover. Why it is a liquidity ratio? Because it tells us how frequently we are going to convert our receivables into cash. So we have already discussed the formula at length in while discussing receivables. So the formula is net credit sales. Remember, these are not the cash sales, the credit sales, these are net credit sales. That is after deducting the allowances and returns, if any, divided by average net account receivable, right? So whatever our account receivable net are, net means after reducing the allowance for bad debt, because that's the contra asset, we average them. Why we average them? Keep in mind, whenever a ratio contains two items, one of which is coming from income statement and another which of coming from balance sheet or the statement of financial position, then the item that is coming from the statement of financial position has to be taken average, right? Because the income is for the period 1st Jan to 31st December, for example, right? Whereas the balance sheet item are either for the 1st Jan or for the 31st December. So which one should we take, right? Because the income is for the entire period. So that's why we take the average of these two. The opening item, that's the closing item of the last year, plus the closing item of the current year. So we take the average. So this happens whenever we take the ratios which contain one income statement item and one balance sheet item. So the average actually is with the balance sheet item. See the previous ratios, both the items were coming from the statement of financial position, asset and liability. So no averaging, right? But here one is coming from the income statement, the other was coming from the statement of financial position. So we have to take the average over here. Similarly, inventory turnover ratio. Uh, so this is the receivables turnover, right? And we can also work out receivable days. We divide the 365 or 360 days divided by the turnover. So how many days on average we are converting our receivables into cash? So this can then be compared to our credit policy, that is 2 by 10 and by 30 sort of thing, and see whether our credit policy is effective or not. If we have a credit policy of n by 30, means debtor, a receivable should be collected within 30 days, and days are 35, actual days are 35. It means that there is something wrong somewhere. And if it is more than that, then something has to be investigated. Similarly, the inventory turnover, right? To what extent we are able to, how frequently we are able to convert our inventory into cash, that we are selling our inventory, right? So the formula we have discussed earlier, cost of goods sold again upon average inventory, the same logic for the average. And again, we can work out the number of days for the inventory as well. And this is 365 or 360 divided by the times. So higher the number of times, more liquid the company is. Lesser the number of days, more liquid the company is, more intensity, more tendency of the company to convert its inventory to cash is higher. Coming on to the profitability ratios, right? So these are the ratios which measures the profitability of the company. So there are two kinds of ratios. One are known as the margin ratios, others are known as the return ratios. So the margin ratios is the profit margin, right? So it can be gross profit margin. This is gross profit upon net sales. It can be net profit margin, which is net profit upon net sales. And again, we can compare these with the industry. And these are very much industry specific ratios, as we have discussed probably earlier in class, because a retail industry has a very lower net sales margin, right? Whereas say automobile industry has a relatively much higher net profit margin. And then we have the turnover ratio, assets turnover. To what extent we are converting our assets into sales? How many times during the year we are converting our assets into sales? So although literally we do not convert our assets into sales, we actually use our assets to make sales. But this ratio actually takes into account this kind of thing, that what is the amount of assets, and from that amount of asset X, how much times of X we are actually generated sales. Is it 0.5x, is it 0.2x, is it 3x, or things like that. So net sales upon average assets. So again, one item is coming from the income statement, the other is coming from the balance sheet. So that's why we take the average. And the assets turnover again is industry specific ratio. Assets turnover in the retail is very high. The profit margin in the retail is very low, but the asset turnover is very high, right? They sell a lot of things a day, right? But the asset turnover in for example automobile industry is relatively low. And return on asset, which is net income upon average asset. So if we multiply these two ratios, profit margin is net income upon net sales, multiply by asset turnover net sales upon average asset, then actually we get this ratio, return on assets, which is net income upon average assets. So again, this is not the true version of the return on assets ratio, right? This is not a true version, because on for the return on assets, right, we need to, in the denominator, we need to take operating profit, not net profit, not net income. But usually the formulas are provided, so don't worry for the examinations or quizzes. Uh, but if the formulas are not provided, then it's better to use the right approach, which you usually study in the other courses as well, in the advanced courses, because assets are the entire balance sheet, right? So the profits attributable to the entire balance sheet is not the net profit, right? It's also the profit which we give out to our lenders. That's the interest. So that's why we say EBIT, earnings before interest and tax, has to become into the numerator, right? So anyway, don't worry, for the purpose of examinations, the formulas will most likely be provided. So net income upon average assets. So the net income we take from the balance sheet, the average asset, again one item from the income statement, other item from the balance sheet, so this has to be averaged. And the return on assets is, this ratio is something not really industry specific, because this is the ratio which can be compared across the industries as well. How much amount we invested, how much return we get. So every business invests for the purpose of getting something, right? Return on ordinary shareholders equity, so this is net income. This is a ratio we have already seen in the corporate accounting part. Net income minus preferred dividends for the current period. Whether we paid them or not, preferred dividends for the current period only we deduct. If they are cumulative, they are pending for last 3 years, we don't deduct. We only deduct the current year's dividend from net income, net profit, divided by average ordinary shareholders outstanding. But average is also outstanding, it's okay. Average ordinary shareholders equity, right? So whatever total shareholders equity is, we deduct the preferred share capital, and then the remainder becomes the average shareholders equity, right? Everything else is the ordinary shareholders equity. So that's the average shareholders equity. Of course, if there are treasury shares, we deduct them while computing the total shareholders equity, because by default it is a part negatively, negative, it is deducted from the owner's equity. So again, average over here in the denominator, because it's coming from the statement of financial position, and this is the numerator. So it says that what is the income on the investment made by the ordinary shareholders. So ordinary shareholders do not get entire net income. The preference dividend, they get the entire net income minus the preference dividend. So this is the amount that ordinary shareholders eventually get, right? Either in the form of dividends or in the form of retained earnings. So divided by the total investments, which is total shareholders equity. Earnings per share, a new ratio for us. Net income minus preferred dividend, same numerator as in ROE, and in divided in the denominator, this is the ordinary shares, number of shares, right? So earnings per share, so earnings for the ordinary shares. So remember, earnings per share is always for ordinary shares. So earnings attributable to ordinary shares, which is net income minus the current year preferred dividend, divided by number of shares. So number of shares, again, number of shares may be different on 1st January, different on 31st December. So again, an average, right? Average ordinary shares and outstanding shares, right? So just like the book value per share, the earnings per share also, we in the denominator, we take the outstanding shares. So whatever are the issued number of shares, we deduct the treasury shares, read the corporate accounting chapter again if the concept is not clear, and then we make the weighted average of the two, and then we take the earnings per share. So this is again a very important ratio in the stock market transactions. Price earning ratio, this is the market price per share, which cannot be calculated, which cannot come from the statement of financial position. It comes from the other sources, right? So the stock market price divided by the earning per share. This is also known as earning multiples, right? So price earning ratio is also known as earning multiples. How much time the market price of share is, how much time of our earnings. So 10.4 times, 12.4 times. So whatever market price is, so I am buying 10 years of earning when I buy this share. So this is my earning per share, say 0.77, but the market price is 8. It means if I buy the share, I buy 10.4 years of earnings. I buy 12.4 years of earnings. So this is a sort of interpretation. Uh, Payout ratio, this is the dividend payout ratio. This is the cash dividend declared on ordinary shares upon net income, right? So dividend payout ratio, again, the cash dividends, the amount of the cash dividend divided by the net income. Remember, the amount of the cash dividend divided by the total ordinary shareholders equity, outstanding shareholders equity, that was the dividend rate, dividend percentage, which we discussed in the corporate accounting. But now the payout ratio is how much of the income is actually you are paying out. So a company announces 10% dividend. It doesn't mean it is giving out 10% of its income as dividends, right? 10% dividend means 10% of ordinary shares capital, right? 10% of outstanding shares multiplied by the par value. But when we say 10% payout ratio, it means whatever my income was, right? So dividends are 10% of my income, right? So if a company's payout ratio is 100%, it means retained earnings are zero for that year because the company is paying out entire net income as dividends. So no retained earnings for that particular year. There may be retained earnings previously. Think about, can a company payout ratio be more than 100%? Just think about it and reflect it in the class discussion. Lastly, solvency ratios, and these ratios actually portray, reflect the long-term ability of the firm to continue to avoid any takeovers, to avoid any bankruptcy or solvency. So majorly there are two ratios: debt to total assets ratio. There's a total liabilities upon total assets. So total assets are always say in terms of hundreds, so they are always on the balance sheet. Left hand side is always total. So how much proportion of the assets is liabilities? So this can be maximum this can be 95%, right, which is not good. So it should be less than 50%, right? So over here you see this 50, this was 50% last year. Out of total asset 1595, almost half were liabilities, and the remaining amount, which is 100% minus 50.2%, which is 49.8%, will be the owner's equity to asset ratio. So debt to asset ratio plus owner's equity to asset ratio is equal to always 1, because total assets is equal to total liabilities upon owner's equity. Uh, Also, there is a ratio which is known as debt to equity ratio, which is the total liabilities upon total equity. So that's also an important ratio. I don't know whether they have discussed in this book or not. So just see the chapter if they have discussed. But apparently they have not. So both ratio actually calculate the same thing, that what is the proportion of liabilities related to your equity or related to your assets, but they have different numbers. So they are used usually for the same purpose. Times interest earned. What is the capacity of our firm to pay interest? So what we pay interest from? We pay interest from operating profit. So net profit plus interest expense plus income tax expense is closer to operating profit usually, right? Maybe there are sometimes other income and other losses, so they are added to the operating profit, and this measure is known as EBIT, EBIT, earnings before interest and tax. So earnings, everything, gross profit, operating profit plus other losses, plus other income minus other losses, stop here. This is the earnings before interest and tax. So just two things before the net profit, that is the interest and tax. So they are added back to the net profit if we working out reverse, or if we work it out positively from the top. So all the things up to operating profit plus other income minus other losses, that is the EBIT. If we working out reverse, so net income plus interest expense plus income tax expense, so that's the times interest earned divided by interest expense. So how many, what is our, this amount, is this amount sufficient to pay interest? If this ratio is 1, it means we are earning just amount sufficient to pay interest, right? If this is 2, it means yes, we can pay interest. We had been paying interest, but we are earning more than that. Over here it is 9.6 times, it is 13 times. So higher the ratio, more safe the company, more solvent the company is. So this is sort of a comparison of different ratios, right? And you should see the textbook as well, and then you should be able to work out the ratios based on any given numbers. In the next video, we shall see some other concepts contained in this chapter. This is the sustainable income and the accounting principles. Thank you.